Good morning, ladies and gentlemen. George Grisham here, speaking with you about insurance, reinsurance. This will be a channel, I hope, and in the channel, each material will have a number. So the numbers between 0 and 3 will be more general, which you still need to review. And then between 4 and 10 will be per particular types of insurance. And today, what we're doing today is studying principles of insurance. That's one of the most interesting bits and pieces I've ever studied in my life. The only thing I can't find my presentation. Let me do it again. Here it is. Principles of insurance. You know, I studied in Chartered Insurance Institute in London between 1990 and 1992, quite a while ago. But I'm sure nothing has changed since then. I was doing the associateship course for about 2.5 or 3 years. And because I was already working in the big sphere, big branch of marine insurance, I was doing non-marine and reinsurance. But anyway, it started with a subject which was called Principles and Practice of Insurance. And I'm so glad to Chartered Insurance Institute, to CIA, that actually I've done this course, because really these principles of insurance we feel every day in every move or step we do in insurance or reinsurance. Very quickly, I understand that you know them, but still very quickly to refresh your memory, there are 7 of them, and it's questionable which one is more fundamental. The utmost good faith or the insurable interest. Let's say that utmost good faith is more important, and that actually depicts or presupposes that the insured and the insurer actually have the utmost good faith between them. The biggest, sort of the highest level of faith, which means that both sides have to trust each other and also have to know a lot about each other, especially as regards the insured. When he is concluding an insurance contract, reinsurance contract, very much the same, directly or via an intermediary, an agent, a broker, he has to disclose information. If he doesn't disclose it, or if he commits a misrepresentation, then in different jurisdictions, the consequences, again, some of them are, in some jurisdictions, they're very harsh, and some others, they are not as strict and severe, but anyway, there will be some, let's say, consequences of breaching the utmost good faith principle. So principle number 1, here it is in the foundation. This is my scheme, which I created, and I'm quite happy about it because I haven't seen it in any other manuals on insurance. And then we go here, insurable interest. Again, the insured, a person or a legal entity, and the object of insurance, which is property, liability, financial expenses, and so forth, have to be connected by insurable interest, which is the subject of insurance, which is the connection, the legal connection between the insured and property. The only thing I have to correct myself, insurable interest actually is the object of insurance, and subject matter of insured property or liability is the subject of insurance. The main problem is that in different jurisdictions, these terms are used, unfortunately, and 180% different. Anyway, the insurable interest, the connection, the legal connection between the insured and the subject matter. Number 2, if there is a loss, there should be causation, train of causation between the loss as an event occurring out there in the big world and the loss which our insured incurs. So that A depends on the insurable interest, and B depends whether this particular event is actually insured under the policy. We have already studied this connection, but anyway, that is one of the most important principles. And then when the loss occurs, the most important thing, or the most important function of insurance is actually to get the loss reimbursed. So then we're talking about the principle of indemnity. The fact that the loss of insured has to be calculated in financial terms, in rubles, dollars, yen, or euros, and the insured, having received the indemnity, has to be brought to the same level as regards the property as he was before, prior to the loss occurred. Still seems to be simple, but it is not, because it all depends on the correlation between sum insured, what's written in the policy, and insurable value. How much is actually the object worth on the market or somehow or other. So this connection, this correlation is very important, and we're going to study it in more details. But anyway, the principle of indemnity, see, it's in the center of my scheme, and it has to be very, very, very adhered to. And then the loss occurs. There are three more, let's say, additional principles which we're going to look at later on. And, you know, I keep on changing my scheme. So sometimes you actually start with the principle of good faith at the very top, because this is really either the foundation or the first brick of the whole, you know, building of insurance. And once again, when we are thinking about these principles actually more or less correlate to the main stages, of participation of both sides, insured and insurer, and the broker, in the insurance process, concluding the contract of insurance, and then actually obtaining reimbursement of a loss. So first of all, if there is no insurable interest, any insurance contract is illegal. You cannot insure, for instance, the life of your aunt or uncle if you're not interested in their financial well-being. Yes, you can insure your children or your wife, but not, you know, people you are unrelated to. Very much the same. A company, a legal entity, cannot insure some property, cannot insure some liabilities if it cannot prove that insurable interest exists. But to get insured, the insured has to be trusting, has to be trustful. He has to explain all circumstances about himself, his company, and all the details. That's called disclosure and representation of a company. And disclosure and representation have to be based on the principle of utmost good faith. Uberrima fide, it's called in Latin, and that means that the insurance company, the insurer, doesn't know anything about the subject and the object of insurance. And they have to be told by insured himself or his broker. Number three, a loss occurs and we have to prove causation. One of the sides is proving causation. Because, for instance, if we have an all risks policy says all risks are covered, but there are some exclusions. So the insurance company has to prove the chain of events between a particular event and the loss, and to prove that the loss was caused by an event which was excluded from the policy. Because all risks insurances still have some exclusions, and vice versa. There are policies which are called listed perils. So, for instance, flood would be covered, but I don't know, lightning or fire would not be covered, strange enough. So then the insured has to show the causation that an event which occurred out there in the world at large actually caused a loss, a financial loss, which the insured has suffered. So the causation, principle number three. And then, having proved all this, and having proved to the insurer that an insured loss occurred, all right, fine, great. Insurance company is going to pay indemnity, reimbursement of insured or reinsured losses. So this principle of indemnity, once again, it depends on the correlationships between the amounts, the sums stated in insurance policy, and how much the property actually is worth out there in the market or on the stock exchange, so on and so forth. And finally, after everything happened, and we're already at the level, at the stage of an insured event, there are three more principles. Number one, sue and labor. Right, the vessel is sinking or the house is on fire. Any insured has to act, what always says, as a prudent uninsured person. He has to try to save his property or his interests, to diminish the amount of, to prevent the loss or to diminish the amount of loss. And this is called sue and labor obligation. Sue and labor, they are actions aimed at reducing the damage or the loss. Number two, contribution. Contribution is financial contribution. First of all, of the insured, that insured has to be interested in the financial outcome of the insurance contract. What does it mean? There are deductibles, i.e. amounts which are not reimbursed by the insurance company if there is a loss. Sometimes the deductibles are in dollars or euros, or sometimes they are in percentage of the sum insured or of the amount of loss. And then on the other hand, if there is co-insurance between different insurance companies, then they're contributing to the reimbursement of the loss, i.e. if there are 200 insurance companies participating, for instance, in an aviation liability policy for $1.5 billion, and I was placing such kind of policies, then each of the 200 insurance companies will be reimbursing a loss in their proportion. That's called co-insurance or co-reinsurance. And finally, the principle of subrogation. Subrogation means that when the insurance company has reimbursed the loss, based on the principle of indemnity, it receives the rights of the insured and can go with a claim against the party which actually has caused the loss. Very often it is, for instance, a carrier. If we're insuring cargo, and cargo was damaged whilst on board a ship or an aircraft, wet damaged, for instance, then the carrier primary is responsible for this. So the insurance company, under the principle of subrogation, receives the rights of the insured and goes against the carrier or against any other third party who can be claimed for the, who can be, send a claim for the damage or loss which the subject matter insured has suffered. That's about it. We've talked about, spoken about 7 principles of insurance. Once again, the utmost good faith, the insurable interest, causation, indemnity, and 3 additional principles, i.e. sue and labor, contribution, and subrogation. Thank you very much for your attention. And please remember that on the channel, you can find different materials and different references. Thanks a lot. Bye.